All right, Zeb, Jody, I'm going to give our attendees a moment to join us. How are you both doing today?
Really good, Allison. How are you?
I am doing well. I'm excited to jump into today's content. I see that our attendee count is rolling up, so I'm going to jump in with some housekeeping items. Welcome, everyone. We are going to get started momentarily with today's webinar. I'm Allison LaForgia, the managing editor of HousingWire's Content Studio, and today our topic is divorce mortgage planning, the untapped market hiding in plain sight. Now, before we get started with today's content, a few quick housekeeping notes. This is meant to be an interactive webinar. So if you have questions for Jodi throughout her presentation, drop them in the chat, drop them in the Q&A icon in the Q&A section. You can use the icon at the bottom of your screen. Time permitting, we'll get through as many questions as possible. Also, a recording of today's session will be sent out to all registrants early next week. So don't worry if you miss something, focus on the content. Now I'm going to introduce the Senior Director of the Content Studio, Zeb Lowe, who will tell us more about Jodi and about today's event. Zeb, the floor is yours.
All right, thank you, Allison. And thank you everyone for joining us today. As Allison said, I'm Zeb Lowe, the Senior Director of the Content Studio here at HousingWire, and I'll be your host for a topic or avenue of business rather that honestly I wish I would have explored whenever I was actively originating. Whenever I began in the industry, I was given this same kind of a cliched blueprint to success as I think almost everyone on this call was, which is, you find a realtor, you partner with a realtor, and magically you found success, right? The loans will just come rolling in. And while there's, certainly there's a lot of truth there, the reality is that there are, besides the fact that there are so many other LOs that are competing for the same business, there are so many other fruitful partnership opportunities and avenues to business and production growth available to you. And we've at HousingWire, we've been exploring these like niche markets and strategic partnerships over the last several months across several platforms here. Our LO-focused newsletter, Lending Life, our monthly contributor articles, and monthly webinars. And today we're going to continue down that path and explore the world of divorce mortgage planning, as Allison said. So I'm going to be taking a back seat today and passing the reins over to Jodi Bruns, the president and founder of Divorce Lending Association. With over 35 years of experience in mortgage and finance, Jodi has dedicated her career to transforming the divorce mortgage planning niche. As the creator of the Certified Divorce Lending Professional and Real Estate Mediation Specialist certification programs, Jodi has a long history of providing mortgage and real estate professionals with tools, resources, and the education needed to navigate the intersection of divorce, real estate, and mortgage financing. So with that being said, and also, side note, I'm at the corporate office and there's I don't know if you guys can hear that or not, there's a ton of renovation going on. So the moment that I start speaking, it seems like the workers are turning on their power tools. So I'm going to mute myself and pass the reins over to Jodi. So Jodi, if you'd like to share your screen and get cooking, we're ready for you.
Hello, everybody. I am super excited to take maybe 30 minutes or so and share some information to you and hopefully change your perspective or your traditional interpretation, if you will, of what the divorce market actually is. And I wanted to start by actually asking a question that, it's something you've probably never really been asked before, in your mortgage career. And that question is, what if, I like what ifs, what if the divorce market isn't really a niche, but what if it's an entire segment of the housing industry that we've all been trained traditionally to overlook? Most mortgage professionals don't think of divorce as a financial trigger. And that's the problem, right? Because every year there are over 1 million homeowners who are ordered to either refinance, sell, or transfer ownership of the home as part of their divorce settlements. But there's a big disconnect there. You know, lenders and mortgage companies are not obligated to follow divorce decrees or court orders. You know, a judge can tell you to do one thing, but they cannot change the original agreement between the lender and the current mortgagees. And they can't, you know, supersede what mortgage guidelines are. And when legal intent, if you will, doesn't match lending reality, it doesn't just hurt the clients, it actually creates risk. It creates a risk for the attorney. It creates risk for us as originators, basically for everyone involved. And if you think about that, too often, there's too many times where families will fall through those cracks. And it's because nobody connects the dots between legal strategies and mortgage execution. And that's one of the reasons I'm here today. That's one of the reasons I talk on this content all the time. Is it's not just to talk about, you know, how we as mortgage professionals can help people through a tough time. It's to show you as mortgage originators and management and executives, everything. It's to show how you have a powerful opportunity, literally, as my title slide says, that's hiding in plain sight. And when divorce mortgage planning is done strategically and early in the process is the key, we don't just protect families who are going through this very devastating life transition. We're actually protecting our pipelines, where we have increased conversion rates and we build referral partnerships that last. And the truth to me is this: the traditional mortgage model was not built for divorce. It just wasn't. Too many families fall through the cracks, again, when nobody's connecting those dots. And when that happens, you know, it's just not a mortgage transaction that falls apart. It's literally a family's stability. You know, it's their children's security. And oftentimes their entire financial future just crumbles, you know, when things don't plan out, even though, you know, the intent is there. There's legal strategies put in place that oftentimes both parties are okay with. But when there's not a way to execute that, and we all know that housing is, you know, it's where we find our security, it's where we find our comfort. And when that's lost, you know, there's so much more at stake. And divorce mortgage planning, to me, it's not about selling a loan. And unfortunately, that is the biggest misconception of originators, is it's just about doing a loan. It's about service. It's about dignity of those going through the divorce. And above all else, and this is where I get really passionate about it, is it's about protecting those families in transition. And it's about, again, making sure that nobody, neither spouse, neither child, loses their home or loses their footing, you know, simply because no one thought, right, to bring the mortgage conversation into the divorce strategy early enough to make a difference. And here's the other thing. When we as mortgage professionals step into this space, we don't just save deals, we change lives, okay? And that's, I think, where the real empathy comes in to professionals who really want to focus on the divorce market. And again, when you look at how many families face this single, you know, life transition every year, you'll see exactly why divorce mortgage planning isn't just important, it's actually essential. And what I want to do is I want to start by showing you how much bigger the divorce market is than you may realize. The most recent CDC data shows, and divorce rates typically lag 1.5 to 2 years. Okay, so the most recent numbers we have are from 2024, just last year. But the current divorce rate is 2.4 divorces per 1,000 population in the United States. And that equals almost little over 800,000 divorces every year in the United States. And that, that might not sound like much, but here's what most people don't realize. That figure is based on the entire US population, which includes children, teens, and others who are not eligible to marry, okay? When we adjust the denominator in that equation to reflect only the population who's age 15 and older, those who can actually marry, basically, not that I would want anyone getting married at 15, but that divorce rate jumps to 3 per 1,000 population. And that's important because that's a 25% increase in the divorce rate, if you think about that. Using that current population number and redoing the formula, that's where that 800,000 number jumps to more than 1 million divorces every year in the United States. And this is why that matters. We have found through working with, thousands of family law professionals, divorcing clients, et cetera, that about 70% of divorcing couples own real estate. Maybe it's just the marital home, maybe it's multiple properties. But what that means is when you use that 70% figure, that's over 700,000 households every year that are making critical decisions about the marital home and other real property. And you really need to remember that there are 2 people affected by every divorce. And that number then, when you multiply it, simple math, right, translates to over 1.4 million newly formed divorce-related households every single year in the United States. And here's the real challenge. There's been a lot of industry case studies done, and they show that a substantial portion of those divorcing homeowners have experienced either a failed mortgage or failed property execution of the settlement orders after the divorce is final. And you ask, well, why is that, right? It's because, again, a judge can order a refinance. A lender is not bound by the divorce decree. So if the borrower or the spouse who needs to refinance the marital home doesn't qualify under current guidelines or current market conditions, the deal collapses. And the fallout is huge. There's collapsed buyouts. There's additional conflict in the divorce or post-divorce. There's more litigation that happens. And unfortunately, the bigger issue is there's families who get stuck with homes that they can't afford to keep or they can't afford to sell because they won't be able to afford to buy a new, smaller house. And the key point is this: the housing industry has never had a system for managing real property and financing decisions in divorce until now. And given these massive numbers and the serious legal consequences at stake, it's crazy to me that there are less than 1% of mortgage originators who have any formal divorce mortgage training at all. Yet it's this shiny new object. They're marketing to divorce attorneys, trying to do divorce loans. There's a risk there. And if you're a manager, or at the executive level, and you have loan officers who are tapping into this market with no training, no understanding, that risk, can come up to you as well. The numbers and stuff, that's why I like to say that divorce is not a niche. It is a true market segment that is hiding in plain sight for us. And what I want to do is I want to show you what that market segment looks like in a way that would more resonate with us as real estate and mortgage professionals. So when we talk about pipeline growth, as sales managers, et cetera, it's always like, where are we going to get loans? We got to grow our pipelines. We usually focus on new home sales, existing home sales, and yeah, there's some refinance activity in there, right? But we need to put divorce into perspective. So as I just said, in 2024, there was a little over 4 million existing home sales, right? And there was also around 670,000 new home sales. If you compare that to divorce, each year, and as I mentioned earlier, there's more than 1.4 million new households formed every year in the United States. Now, to be clear, what I'm not saying is that all 1.4 million households show up as direct sales or refis within those existing numbers. Because unfortunately, there's no, national tracking mechanism, et cetera, that separates divorce-driven transactions. But, okay, for comparison purposes, look at this scale. These newly formed divorce-related households equal nearly 35% of existing home sales and is more than twice the value or the volume of annual new home sales. And here's the key. Divorce isn't cyclical, right? It doesn't rise and fall with builder activity or investor trends. And it's consistent year after year, which makes, this, again, one of the largest and most reliable yet least recognized drivers of housing transitions in the country. And one of the questions that I do get on a regular basis is, well, isn't the divorce rate falling? Because a few years ago, especially right before COVID and right after, it was in the threes. The issue is numbers are always skewed, right? Why the divorce rate looks like it may have fallen slightly is because the marriage rate has fallen. So there's less divorce or marriages to get divorced or separated, but historically, this market, it's consistent. And unfortunately, it will always be there. And that's why we need to look at it as an opportunity, not only as a business model, but as an opportunity to help those families that are going through a divorce. I want to break down more for you now what this really looks like for us as a business model. When most originators think about divorce, and I would bet that many of you on here are going to agree with this, okay? When you think about divorce, you typically put divorcing homeowners into two boxes. Box one needs a mortgage, box two doesn't need a mortgage. And that's it. If the client fits into box one, great. There's a potential loan there. But if they're in box two, they are typically dismissed. They're just overlooked as a lost opportunity just because they don't need a mortgage. Just because they don't need it right now doesn't mean they won't tomorrow or the next month or a few months down the road. So don't get caught up so much in the weeds that you miss the bigger picture. And the problem with looking through this at the divorce market through a traditional lens is it's very short-sighted. We're trying to close loans when we should be looking at it as an opportunity to open doors, right? So what it does is this mindset, this box one, box two, et cetera, it reduces those who need a mortgage into nothing more than a transaction. And here's the other issue with that is, why do you think so many loan officers get excited about marketing to divorce attorneys? You know, I mentioned earlier, it's a shiny new object. Oh, you know, the real estate market slowed down. I need to find a new referral source. Well, let's go to divorce attorneys. They always have clients who need a mortgage. And then it doesn't work out that way, right? And so many loan officers, they say, I tried that, it doesn't work, and they quit after a few months. The reason for that is the traditional model doesn't work. It's very unsustainable, okay, from a mortgage perspective. Yeah, you walk in, you may get 1 or 2 quick referrals, and you're like, dang, this is good. And then all of a sudden, you're putting in all this effort, and it's like, this is taking too long. You know, so what do I mean by unsustainable? It's because of the lead time. You know, from initial contact or initial filing of the petition, all that way to loan closing, it can take a couple weeks. It can also take months. And you might invest hours answering questions, running numbers, and even issuing multiple pre-approvals. And then maybe the divorce case drags on, it stalls out, or worse, you know, you've got this window of opportunity, right? The divorce is final. They can't close for 6 months. What happens? Vinny walks in. You know, I always like throwing Vinny in there because we all know Vinny. He's my sister's boyfriend's cousin's friend who just got his mortgage license last week. You know, so we have to walk into this market with our eyes open, what the true opportunities are and the true hurdles are. But the ticket, if you will, to making divorce one of the smartest markets to capitalize on is, again, one thing that I'm going to say this number and you guys are going to remember it and think about it tonight is every one of those 1.4 million divorcing homeowners, what they need in their divorce, even if they don't need a mortgage today, is strategy. Every single one of them. They need strategy, and that strategy and that need for that strategy is the missed opportunity that I'm trying to highlight for you, okay? Divorce mortgage planning is the true missed opportunity, but only if you truly understand what it is and the many opportunities that it can actually create for you now and in the future. You will never, and I've worked with a lot of mortgage clients, you will never find a more loyal client than a divorcing client. Someone who you helped in one of the most devastating times in their lives. You will get more secondhand referrals from that demographic than any of your other past clients. I promise you, I guarantee it, okay? And talk about the family law professionals, they are more loyal than any other referral partner you will ever come across. Not to mention that they don't work weekends and nights. So that was kind of nice. But, you know, let me get back on track here real fast. Before I get more into unpacking the full opportunity, I want to define what divorce mortgage planning really is, okay? When most people hear the term, they assume it just means helping someone get a loan during the divorce. But that's like saying financial planning is just opening a new bank account. We all know it's not the same thing. What it does when you have that limited insight as to what divorce mortgage planning is, oh, it's just doing a loan, it misses the strategy. It misses the foresight and the risk mitigation that's behind it. And at the Divorce Lending Association, I'm very proud of this. We have defined and shaped divorce mortgage planning into its own professional category. one that integrates mortgage solutions into the legal and financial framework of divorce. It's no longer a niche. It's a profession. And you will hear me say that again, I'm positive. But again, this isn't about just closing a loan. It's about ensuring housing stability, protecting equity, and supporting, fair and financeable outcomes for our clients now and in the future. We don't treat it as a product, okay? It's a profession. So I want to take a look at what that actually means to be a divorce mortgage planner and what it doesn't mean, okay? Because I think that's important too. When people first hear about divorce mortgage planning in our industry or the CDLP designation, they write it off. They say, I've heard it, it's too complicated. It's just marketing. I've even heard it sounds like a scam. But here's the thing, scams don't pass audits by RESPA, TILA, UDAP, and OCC regulators. Ours has. And it's been endorsed by some of the toughest legal and compliance teams in the country. And I'm proud to say it comes out clear every single time. And, it's not a clever pitch. It's a professional response, again, to a serious gap between legal intent and lending reality. Divorce mortgage planning, again, it brings strategy to the table before settlement agreements are locked in. It prevents issues, like I mentioned before, failed refinances, missed equity buyouts. Maybe a spouse is waiting for their equity so that they can put a down payment on their new house, and then the refinance falls through. Well, guess what? So does the purchase. It's a big issue out there. And yeah, I get it. Any licensed originator can do a loan for a divorcing client. I am not arguing that. But that's doing a loan. That is not planning. Okay? Real planning requires understanding the legal, the financial, and the mortgage intersection, and knowing how to collaborate across those many disciplines that are out there to get the strategy right for that client's unique situation. And when you do that, when you're the person that's bringing the strategies and the solutions, you stop being the person who shows up at the end, and you become the advisor who shapes the outcome. So it's not something you tack on to your marketing plan. It's something that you build in to your mortgage business plan. All right. The other thing that I think is important to address before I keep unpacking that big flow chart at the beginning is divorce is never a one size fits all. Each case has unique assets, income sources, debt structures, parenting plans, and housing needs for, again, both parties now, not just one. And that means that surface level mortgage knowledge simply is not enough. To bring value, you have to understand, again, how legal decisions interact with lending guidelines. You need to recognize when tax planning strategies can create usable income for mortgage qualifying purposes. You need to build mortgage feasibility into both short-term and long-term housing outcomes. And yes, you have to be able to read and speak to the language used in the settlement agreement. And I always hear, what? I'm a mortgage professional. You want me to tell an attorney what language to use in their settlement agreement? Yes, I do. And trust me, they appreciate it. And they are reaching out to our CDLPs to ask for the language they should use in the settlement agreement. They aren't mortgage professionals. And what may be a legal option to them may not always translate to a mortgage option. And that's the message that we have to get across. So that leaves you as the person who is bringing the strategies and you're required, to step beyond your traditional originator lens and into that strategic forward thinking role. But that's the difference. That's where the opportunity lies, when you can learn how to differentiate yourself from the competition. Okay. It's that whole, red ocean, blue ocean theory. How are you going to differentiate yourself? Right. So I want to expand upon the earlier slide that you guys saw. When we talk about divorce mortgage planning, all right, we're not talking again just about helping our clients. We're talking about building a business model that I'm going to probably say most of you on this call don't even know it exists. All right. I want to look at 5 key attributes that make this one of the smartest and, yes, still most overlooked opportunities in our industry today. First, a sustainable business model. Okay. If you blend, and this is where you guys are kind of raise your eyes, if you can blend fee-based consulting with traditional origination, you create consistent and reliable income. You're no longer held hostage by unpredictable, refinance cycles or seasonal purchase markets. You're already doing the work. You can get paid for it strategically. Okay. And secondly, there's accelerated, revenue growth. Again, go back to, what's the number? 1.4 million divorcing households, right? That are formed every year. That's an enormous pool of business being left on the table. And the truth is, again, if you don't capture it, someone else will. And when you become the expert who wasn't focused on, just getting the loan, you truly become the referral partner that they will bring in on so many divorce cases. And I like this one, the gatekeeper. Too many times we think of the gatekeeper, right, as somebody we got to get past. And I kind of laugh at that. Gatekeeper becomes a bad word, right? Especially when you're trying to get past the gatekeeper. But it's a good thing when you become the gatekeeper, right? As a CDLP, again, you're not waiting for a client to come to you with a decree in hand and their settlement agreement and asking you to make it work. You become that professional they trusted first because you were the one that influenced the outcomes to make sure the mistakes weren't made. That's a seat at the table. That's not a seat in the waiting room, right? And remember, I know you guys can picture this, the funnel theory, right? As originators, we have been taught for so long just to throw as many contacts into our funnel and be prepared to capture the ones that are falling out at the end. Well, this model, if you will, literally flips that funnel upside down to where you're the gatekeeper. You're getting all of these people who are already committed to you. They've already invested in your knowledge. They're committed to following through with your plan, the strategies, everything, so that those few that you're opening it up so that more are coming out at the bottom ready to work with you. And that's a pretty big visual if you know what I'm talking about, with that funnel theory. And then fourth and fifth, I guess it just clicked up, the conversion rates. If you think about it, when you consult strategically, because there's a method to our madness there, your clients aren't shopping around for the lowest rate. They're committed not only to you because you're the one that guided them, but they're committed again to the strategies and the orders. And because of that, the client, the consultation client to mortgage client, that conversion rate is higher And then your actual close ratios go up because you have higher quality clients that are waiting for you. And, you know, the last one here, the stronger professional relationships, I cannot say that this much stronger than I love working with family law professionals. You've got attorneys, mediators, financial experts, there's divorce coaches now. There's a whole number of professionals underneath that family law umbrella, including CDLPs. And when you are the person who brings the strategies, you're the one who saves the cases, and you make the family law professionals look good, you become indispensable. Now, I will tell you that I have not worked in the Chicago market for, well, since 2015, so a decade. I still, to this day, have referral partners that trust me with their clients, and they still call me to help with strategies and solutions. So I hope that I'm starting to show you guys a different perspective of the divorce market. But I want to now start to kind of get more into what the journey and the process of divorce mortgage planning is, as we, you know, so I can have some time to answer your questions at the end, obviously. But up till now, we've talked about the opportunity and the outcomes, right? And the missed opportunities. What I want to do is look at how divorce mortgage planning actually works in practice, all right? What you see here is a roadmap that we built out, the divorce mortgage planning journey. And it is a 5-phase process that runs in parallel with the divorce itself. It begins with discovery. You know, we have to have that client assessment. We have to identify their needs, you know, and what do we have to do? What's their primary goal? Then we move into the initiation phase, where we're assessing, you know, the feasibility, the financial stability. How can we create settlement goals that are realistic? And then from there is where we step into the actual planning, where we're working hand in hand with not only the client, but the legal team. We're identifying hurdles and strategies and what we can do from a broader perspective to create a really good outcome. You know, this is where we get thick in the weeds. We're anticipating challenges. We're addressing income and debt allocation. And we're trying to really structure solutions before they become obstacles. And then finally, you know, we have execution and closure, where we're able to close a mortgage in compliance with the court order that we helped set up. All right. Now, what I want you to do is notice how these phases overlap directly with the divorce process itself, from financial disclosure and discovery through negotiation, settlement, and the final judgment and decree. That was intentional on our part. Our work doesn't just follow the process, it strengthens the entire process throughout. And this alignment, again, is what prevents those last minute surprises. And it prevents those, you know, costly divorce failures, if you will. And the thing I want you to think about is this: divorce mortgage planning isn't a side service, okay? It's a structured journey that ensures the legal settlement and the lending guidelines don't collide. And it gives the client that housing stability that gives you a repeated, sustainable business model, okay? And when the divorce process and the mortgage planning run in parallel, clients succeed, but then so do you, all right? One of the other things before I introduce to you our CDLP hybrid business model, I want to address one of the most damaging myths in our industry. The belief that if a settlement agreement says a spouse must refinance, the refinance will happen. no matter what the rate is. Well, it's very disingenuous, if you will, when someone says, oh, work the divorce market, rate proof your business. It actually shows, number one, that they have zero clue what they're doing. But the truth is, lenders, again, they don't care what the decree says. If the client doesn't qualify under current circumstances and guidelines, the loan's not closing, period, right? When that happens again, deals collapse, credits are ruined, stability's gone, etc. And the other thing I want to clear up is another misconception. And that is that divorcing clients are not rate sensitive. Divorcing clients are absolutely rate sensitive. And to suggest otherwise is not only false, it's actually insulting to them. And they know exactly, we do too, right? They know exactly what it means to give up that current 3% interest rate, where they're going to trade it in for 6.5%. And they understand there's going to be an impact, especially, if a significant portion of their household income is leaving the household. Rate sensitivity doesn't disappear in divorce. It actually multiplies. So what we do is we come in and we help them see the full picture. And that's why our hybrid business model exists. It allows our CDLPs to step in early, to explore strategies like loan assumptions. We discuss the actual cost of keeping that low interest rate because it actually might not be in their best interest. Or a lot of times we're helping build alternative solutions directly into the settlement agreement. And this way, again, clients aren't forced into impossible situations just because our market shifted once again. And this is exactly, again, why divorce mortgage planning matters. Because, the strategies that are written into the decree, they have to be more than just words on paper. We have to work in the real world. We have to make sure that our clients can meet the terms of their agreement. So now that we have seen the size of the market and the missed opportunities of overlooking it, I want to talk about how to actually make this a sustainable business model. This is where our CDLP hybrid business model comes in. It is a dual income stream opportunity to serve divorcing clients regardless of the box you put them in. Need a loan, don't need a loan. And here's the key to the path you choose, okay? Consulting, origination, or both is entirely driven by the client's needs. If you find yourself building out financial models, going to mediation, you're participating in collaborative cases, the attorneys want you at the table. You might even be called as an expert witness. Regardless of the role you play, they expect you to be compensated for your time. Divorcing clients expect you to be compensated for your time. And so don't think that they don't think they should pay you. They're more surprised that we couldn't get paid in the past. All right. On the other hand, if the client's needs are leaning more toward an immediate mortgage solution, that's the direction you take. You go straight to opening a mortgage application. You don't have to do both. It's either, what do they need? Do they need analysis? Do they need strategies? Everything? Or do they need a mortgage? Because if you do the strategies, et cetera, eventually they're going to need the mortgage, right? So the beauty of this hybrid model is that both paths ensure you're compensated for your efforts, while you're also, this goes back to the missed opportunities, you're building stronger referral pipelines, deeper professional, partnerships, and a long-term foundation for success. And here's the amazing thing that we didn't even expect when we rolled out this business model. The family law professionals refer our CDLPs even more. You're probably going, well, why would they do that? It's simple. It's because our compensation is no longer tied to the outcome of the divorce in the form of a commission. We've heard several attorneys say they'll refer us more because of that we can actually be more of a neutral than an advocate, and there's no question of steering, et cetera. So this hybrid model is really how we stop, again, missing all those opportunities that I spoke about in the beginning. And I know that many of you are sitting there thinking, how is this 1 million, or this is the $1 million question, is what I'm trying to say, is how is this compliant, right? We have all of these regulations in the mortgage industry. This hybrid model has been on my, how do I accomplish this for our CDLP list for a very long time. It's not rocket science, to notice that the industry is shifting. Many mortgage professionals are seeing their volume dry up, their margins are shrinking, and all of our opportunities are stalling. Some are even stepping away to take second jobs, just to make ends meet. And that doesn't solve the real problem, right? It pulls them away from the profession they've worked so hard to build. You don't need to leave the industry. You just need a better way to stay in it. And this is the only program in the industry that delivers advanced education in family law, financial and tax planning around real property and divorce, a business development and coaching platform, and a compliant path to consulting revenue and mortgage origination, all under one roof. So what if instead of pivoting away, you elevated everything you already know with expertise, clarity, strategy, and compliance? That's what we built this model to do. So it's been about 2 years ago when I finally figured out how to make the divorce market not only viable, but sustainable. And I did, I cracked the compliance code. And I mentioned earlier that our model has been validated by leading compliance attorneys, auditors, and mortgage companies, which gives our CDLPs unmatched, confidence in their ability to offer consulting services without that compliance risk. And this isn't just about compliance, okay? It's about redefining the role of the mortgage professional in divorce. CDLPs are not quote unquote divorce-friendly lenders. They're housing strategists. You are embedded in the divorce team. You have a seat there. And we have CDLPs since we've launched this that they stopped leaving money on the table. They stopped missing those opportunities. They build stronger referrals. Some of our CDLPs, like myself, focus only on the consulting model. And then they have a team member at the mortgage company handle their loans. We have CDLPs who handle it all. Again, like I said, I personally hold my active license, but I only do the consulting side of it. So you won't see numbers, if you pull my numbers. So it is a very strong business model that I want you guys to really think differently about. And one of the last points that I want to bring up is an important one, and that's AI. Okay. We live in a world where you can ask ChatGPT just about anything, right? And it'll give you an answer in seconds. That answer may not be correct, but it's quick. And the truth is you cannot ChatGPT your way into divorce mortgage planning. Why? Because it isn't about quick answers or Googleable, if I can say that, knowledge. Divorce mortgage planning is, again, integrating mortgage solutions into the legal and financial framework of a divorce. You can't get that from an AI prompt. It takes training. It takes a deep understanding of guidelines, underwriting guidelines versus cash flow. It takes collaboration with attorneys and financial neutrals, and it takes the ability to navigate emotional, legal, and financial complexities all in one. So in other words, information alone does not equal expertise. execution, compliance, and strategy do. So I've seen a lot of things recently. Oh, you can chat GTP this. You can't. Okay. You just can't. You can ask chat GPT if she can do it. I call her a she. So as we wrap up today, I want to bring us back to where we started. Okay. We began with the idea that divorce is one of the most overlooked financial triggers in the mortgage industry. Yet every year, more than 1 million divorces intersect with real property, creating opportunities that most originators don't even see, don't even know that are there. We talked about, why this market is far bigger than most people realize, why the traditional approach is unsustainable, and how divorce mortgage planning as a CDLP is changing the game. My goal today was to open your eyes to the scope of this opportunity and to show you that divorce mortgage planning is not a niche, it's a profession. One that not only protects our families, but it creates recession resistant, not proof, revenue, stronger partnerships, and unsustainable business growth. And I realized that, in opening your eyes maybe to a new way of thinking, I probably also created many questions, which I welcome that. Questions are the way we all grow, right? So if you're ready to explore, because I know we got about 10 minutes for Q&A, if you're ready to explore what the CDLP really looks like, or maybe you're just curious, I would encourage and welcome you to visit our website at divorcelendingassociation.com, or you can go straight to our CDLP page at getcdlpcertified.com. So I hope I was able to change everybody's perspectives. If there's any questions, I'd be more than happy, to answer them now or connect with you guys one-on-one. It's just kind of depends on if I blew everybody away, put them to sleep, whatever I did.
Jodi, thank you so much for sharing your insights. There's been a couple questions in the chat, so time permitting, to our audience, continue to send your questions. We'll get through as many as we can before our time with Jodi is up. So the first question that I have is, I'm licensed in 2 states. Do I have to be physically present at the table to offer my services as a divorce specialist?
No. I will tell you, you build your market locally. You just do, because it is a trust-built relationship. And you need to obviously be licensed in the state where you're going to offer a mortgage, but you don't have to be licensed to do divorce mortgage planning. That's the key concept of it. But that I always discourage our members to just start building nationally, because you need to build those local relationships. But I will also tell you that I have done probably 95% of my consultations via Zoom, and only, when I was back in Colorado or Illinois, would I sit down with the clients face to face.
And I've seen a couple questions about a recording. Yes, today's webinar was recorded. If you missed anything, if you want to send this recording out to other people, send it to your members of your team, other people in the industry, you'll be able to do so early next week. We will be sending that to you if you are registered in your inbox. It'll also be available on housingwire.com/videos. And our next question is the market with attorneys hard to penetrate?
Not if you have the right approach. There's approach to it. I will tell you, if you go in, with if there's realtors on here, there's no disrespect. If you go in with a team, I'm a real estate agent, I'm a mortgage professional, we can help your divorcing clients. They will see you as a sales team a mile away, and you will never get past that gatekeeper. So you have to have value. What are you going to do for me? Not just my client. What are you going to do for me? So there's a method to it. There's a message to it, et cetera. So it's very doable, but if you do it the wrong way, you're not going to get past and you're going to give up.
And how many years of experience do you recommend a loan officer having before trying to undertake serving this market segment?
So it literally depends on you. You know, what was your background prior to? You know, how comfortable are you talking with this different level of professionals? We have seasoned loan officers who have been loan officers for as long as I have, you know, 30 plus years. We also have some very successful CDLPs who were brand new to the industry, but maybe they had a financial background, or, you know, just depends on that professional background, and they're out there kicking it. And it's funny because some of the people who are newer to the industry do better because they're not so stuck in the traditional approach to marketing your mortgage services. So they're a little more flexible to the ideas and the strategies, because it's very hard sometimes to untrain how you've been trained.
That brings me back to Zeb's introduction, how he was saying he thought that he got a playbook on how to do things. So I like your point that it might be easier for some people, depending on the person, to
Yeah, I will say it is not for everybody. You know, when we have originators call us and they're talking to us about our program, we never try to persuade somebody to do this, you know, because our reputation's on the line, the financial stability of the clients are on the line. And if it's not a good fit, or you have a hard time really kind of understanding the concept, we will probably dissuade you from doing it just because there's so much at stake.
And I think we have time for one more question, and it is, do you have reverse mortgage only professionals specialize in this, or
We
do
do.
you couple up with CDLP loan officers?
We actually have a good handful of CDLPs who focus only on reverse mortgages. And that's literally because the senior divorce demographic is one of the largest divorcing demographics right now. All the baby boomers, you know, they're living longer, they're more financially stable, their kids are out of the house. And that is the fastest growing demographic. So yeah, there's absolutely a place for that. And we have CDLPs who specialize in reverse, and we have CDLPs that when they're presented with an opportunity for reverse with one of their divorcing clients, instead of referring it to somebody else, maybe in their company, they partner up with a CDLP who also knows the divorce strategies, et cetera. So it's a very good teamwork community that we've built.
All right. Well, Zeb, we are inching closer to the top of the hour. I'm going to pass things over to you to close up.
Thank you very much. And yeah, as Allison said, that wraps up our webinar today. A big thank you to Jodi for sharing your expertise with all of us. A reminder to our heads up for our audience: if you submitted a question that we didn't have time to cover, don't worry. Our speakers will follow up with you. We'll follow up with you directly. HousingWire will be sending a recording of today's session to all registrants next week. You'll be able to access the full webinar and copy of the presentation on our website at housingwire.com/webinars. And before you go, make sure that you're subscribed to Lending Life. It's our must-read newsletter for mortgage professionals. Stay ahead of the curve with breaking news, expert analysis, and industry insights delivered straight to your inbox. You can sign up at housingwire.com/newsletters. And thank all of you again for joining us. We look forward to seeing you at a future HousingWire event.
Thank you, guys. I appreciate it.
Thank you, Jodi.